Tesla has been a monster stock over much of its history, especially during its stratospheric run from mid-2019 to late 2021. But it's been a big loser in 2022, down about 65% since the start of this year. And it's sunk about 44% since Musk completed his controversial acquisition of Twitter on October 28. Musk bought Twitter in a contested $44 billion deal, and he has sold billions of dollars in Tesla stock in order to help finance the deal, much to the consternation of investors. He quickly shook up management and staff throughout the company's workforce, eliminating about half of Twitter's 7,500 employees. In the process, Musk also has rattled Tesla investors that have grown increasingly frustrated with the amount of time and money he has spent tearing down Twitter in order to rebuild the social media site to his liking. In today's video, we are going to show you, is it a good time to buy Tesla stock? Without further ado, let's begin. Investors who have held shares in electric vehicle maker Tesla over the past year are in quite a bit of pain, with shares declining 70% in 2022. In December alone, the share suffered near 40% losses, netting its fifth straight month of declines, as evidenced by the company's fourth quarter delivery totals. Don't hold your breath, expecting the pain to subside anytime soon. On Tuesday, the shares plunged as much as 15%, falling to a new 52-week low of $104.64, marking the company's biggest intraday decline since September 2020. The reason for the punishment? The company said on Monday delivered 405,278 vehicles to customers in the last 3 months of the year, missing the consensus estimate of 420,760 that analysts had forecasted. The delivery miss raised more concerns about the level of competitive demand pressure Tesla has begun to face even as it ramps up production capacity at its various plants. And it hasn't helped that many analysts believe that CEO Elon Musk's purchase of Twitter, where he currently serves as CEO, will stretch him too thin to get Tesla back on track. These same Wall Street analysts wasted little time cutting their price targets on the stock, leaving Tesla with its lowest average 12-month target price since October 2021. However, while the Q4 delivery miss raised alarm bells about Tesla's growth capabilities, not everyone sees this as a doomsday scenario. Peter Garnry, head of the equity strategy at Saxo Bank, noted that this year will likely prove to be a difficult one for Tesla due to margin pressures and ever-growing competition, but the EV maker is here to stay and demand will continue to grow. Meanwhile, trust analyst William Stein is also optimistic, suggesting now might be the best time to buy Tesla stock, writing in a report, long-term investors should keep their eye on the prize and buy Tesla. To be sure, Stein lowered his price target on the shares to $299 from $348. However, from current levels of around $112, that still represents potential premiums of 166%. Cathie Wood, CEO of flagship ARK Innovation ETF, ARK, hasn't wavered in her bullish opinion of Tesla. The innovation-focused asset manager bought more than 175,000 Tesla shares across 2 of her actively managed ETFs. Wood and her team have been actively buying Tesla over the past month, acquiring close to 400,000 shares from December 16 through the end of 2022 as it has made new 52-week lows. Time will tell if these are prescient acquisitions. For now, while there are still some questions about Tesla's first half 2023 results, namely gross margin improvement, the stock is now more attractive from a risk versus reward perspective. Tesla is set to report fourth quarter earnings on Wednesday, January 25 after the close. In the 3 months that ended December, Wall Street expects the company to earn $1.22 per share on revenue of $25.1 billion. This compares to the year-ago quarter when earnings came to 85 cents per share on revenue of $17.72 billion. Assuming a top and bottom line beat and strong guidance for the full year, the shares might rally. But analysts will focus on automotive gross margin, which has trended in the wrong direction in the past couple of quarters. In late December, Wedbush analyst Dan Ives laid out what tasks Musk needs to do to turn Tesla positive in 2023. Among them is the name of a CEO at Twitter by the end of January. Another is to stop selling stock, as Musk sold roughly $40 billion of Tesla stock in the past year. Lay out the strategic plan for Twitter. Ives said it in a note to clients. Right now, very simply, the fear is that Twitter is bleeding money with advertisers fleeing for now, which means more losses and therefore more Musk Tesla stock sales. He said Musk must turn his attention back to Tesla and announce a major stock buyback. A longtime Tesla bull, Ives also said Tesla stock is under heavy pressure due to concerns about the possibility of an extended production shutdown in China for January. He also thinks that higher inventory levels, recent price cuts, and overall production slowdowns in China suggest that Tesla will likely miss reduced street estimates for the fourth quarter, and he expects a softer trajectory for 2023. Whether the worst of the Tesla Twitter drama is over depends on who is talking. 6 analysts recently cut price targets on Tesla stock, but their price targets stayed well above current price levels. Overall, analysts have broadly maintained buy and outperformed ratings. Baird analyst Ben Callow, in a note to clients, recently called Tesla a best idea stock in 2023. He kept a buy rating, saying the company remains positioned to capitalize on the growing demand for electric vehicles. We continue to believe Tesla is best positioned in the auto market as electric vehicles continue to take a share of the total market, he said in a note to clients. However, near-term pressure still caused Callow to sharply cut his price target, taking it down to $252 from $316. Callow said he was lowering estimates to be conservative due to recent comments by Musk and the potential for the weakening of demand. Oppenheimer analyst Colin Rush recently lowered his rating on Tesla over concerns about Twitter-related risks. We believe Musk is increasingly isolated due to being the steward of Twitter's finances, Rush wrote in his note to clients. Analysts say Musk's advocacy of unfettered speech on Twitter and his dismantling of content moderation on the social media site has caused a growing number of consumers to turn sour on Musk. It has also caused major advertisers to pull back spending on Twitter, which has caused a massive drop in revenue, Musk said in a tweet. We see the potential for a negative feedback loop from departures of Twitter advertisers and users due to inconsistent standards, resulting in increased financing needs that may lead to incremental Tesla sales just as Tesla's competitive environment intensifies, said Rush. Odds estimates that Tesla vehicle deliveries in the fourth quarter now are likely to be in the range of 410,000 to 415,000. That's down from prior estimates of 450,000. The reality is that after a Cinderella story, Tesla is facing some serious macro and company-specific EV competition, I'd said. So guys, let me know your thoughts down in the comments section below. Give this video a thumbs up for more interesting content, and don't forget to subscribe to the channel for more awesome content. Have a nice day, and I will see you in the next video.